Okay, so we have question on Memo, a public company. We've already done this question on Harvard and Kako. I think that was the one we did in the last class, right? So let's just quickly look at this. We have Memo, a public limited company, owns 75% of the ordinary shares of Random, a public limited company, which is situated in a foreign country. Memo acquired Random on 1 May 20x3 for 120 million crowns when the retained profits of Random were 80 million crowns. Random has not revalued its assets or issued any share capital since its acquisition by Memo. The financial statement relates to Memo and Random. We have all of this. Assuming all figures are correct, the following information is relevant to the preparation of the consolidated financial statement of Memo. A. Goodwill is reviewed for impairment annually. At 30th April 20x4, the impairment loss on unrecognized goodwill was 4.2 million crowns. During the financial year, Random has purchased raw materials from Memo and denominated the purchase in crowns in its financial record. The details of the transactions are set out below. Raw materials, date of transaction, 1st February 20x4. The purchase price is $6 million. Profit percentage on selling price, 20%. At the year end, half of the raw material purchase were still in inventory of Random. The intergroup transactions have not been eliminated from the financial statement, and the goods were recorded by Random at the exchange rate ruling on 1st February 20x4. A payment of $6 million was made to Memo when the exchange rate was 2.2 crowns to $1. Any exchange gain or loss arising on the transaction is still held in the current liabilities of Random. Memo has made an interest-free loan to Random of $5 million on 1 May 20x3. The loan was repaid on 30 May 20x4. Random had included the loan in non-current liability and had recorded it at the exchange rate on 1 May 20x3. The fair value of the net asset of Random at the date of acquisition is to be assumed to be the same as the carrying value. The functional currency of Random is the crown. The following exchange rates are relevant to the financial statement. Memo has paid a dividend of $8 million during the financial year, and this is not included in profit or loss. It is the group policy to value non-controlling interest at acquisition at its proportionate share of the fair value of the subsidiary identifiable net asset. Prepare a consolidated statement of profits or loss and other comprehensive income for the year ended 30th April 20x4 and a consolidated statement of financial position at that day in accordance with international financial reporting standards. Okay, so some of the distinguishing factors in this question, which is why I would like us to look at it, is one, there are other adjustments to be made by the company by the foreign subsidiary to their financial statement. Adjustment like what? You can see they had some transaction with their parent company, which requires exchange translation that they did not do. One, and two, there is impairment of goodwill, and I don't think any of the questions we've done before has impairment of goodwill. Can you guys still hear me clearly? Are we together?
Yes, sir.
God bless you. Okay, so we have Memo Group. Memo Group. So in Memo Group, we have Memo acquiring Random. Memo acquiring Random, 75%. NCI is 25%. Date of acquisition and date of consolidation being what? Date of acquisition is 1st May 20x3 and date of consolidation being what? 30th April 20x4. So as you can see, the date of acquisition to the date of consolidation is exactly 1 year. So no issue of media acquisition on that. So we are good to go. So we have note 2. So from the additional information, we were told that what there was impairment of goodwill. Wait, we don't need that yet. We go to the next one. Random purchase raw materials from Memo. Random being the subsidiary, Memo being the parent. Purchase goodwill. Purchase raw materials. Now, on the day they purchased that raw material, we were given the purchase price in million. But we were told that Random recorded the transaction at the exchange rate on that 1st February 2024. However, they have made a payment of 6 million during the year. They made a payment of 6 million during the year, meaning they've already settled that transaction in full. You look at it, what they bought is $6 million, and what they paid is also $6 million. So no issue, they don't have any outstanding. However, the rate on that 1st of February 2024, if you look at this, rate on 1st February 2024 is 2 crowns to $1. But the rate on the day they paid, they said is 2.2 crowns to $1, meaning there will be an exchange difference. And he told us the exchange gain or loss arising on the transaction is still held in the current liabilities of Random. How? On the day they had the transaction, exchange difference, on raw material purchase. So what's the exchange difference? On the date they bought the raw material, which is 1 February 2024, the $6 million will be multiplied by the exchange rate, which is 2 crowns. Remember, we have said what? When the currency are different, you multiply to convert. When they are the same, you divide to convert. So this will give us how much? $1 million. It will be in crown. In crown, because we are converting to crown. So we'll have crown in millions will be 12 million, right? But as at the day they pay, as at the date of payment, we don't know the date of payment. Date of payment, we have what? They paid them $6 million, but it was at the rate of 2.2 crown, and that will give us how much? $13.2. So meaning what? We paid more than what we actually have on that day, on the day we entered into the transaction. That means there is what? There is a loss of 1.2. There is a loss of 1.2 exchange loss. But what are they now implying with this last statement, that the exchange gain or loss arising is still held in the current liability, exchange loss? On the date they did this transaction, they would have debited what? Their inventories and credited what? Payables. On the date of payment, what would they have done? They would have debited payables and credited what? Bank. But this is wrong. This entry in payables is wrong, because if the transaction you are settling has a 12 million value in the payables account, what you should also take out from the payables should be 12 million. So what that implies is that this 1.2 million that they were supposed to take as exchange loss, they left it in their payable account. So the double entry for this one will now be what? Debit SOPL as exchange loss, debit SOPL as exchange loss. Exchange loss. And credit what? Credit the payables account. So that way you will see that the total credit we have in payable, which is 1.2 and 12, will be 13.2, and the debit in payables is also 13.2. They nil off each other. So that transaction has been fully settled. It doesn't need to remain in the payables account. So this is an adjustment they are supposed to make to their account before consolidation or anything. They ought to have done this. The next one is that what? We were told that they made Memo, which is the parent, made an interest-free loan to Random of 5 million. on 1st May 20x3. The loan was repaid on 30th May 20x4. That is, the loan will be repaid in what? In 1 year, in 1 month's time. However, they included the loan in their non-current liability at what? And they recorded it as the exchange rate on the day the loan was given. IAS 21 specifically states that what? Monetary transactions must be restated at the closing rate. So if they recorded it at the rate on 1 May 20x3 and they are preparing account as at 30th April 20x4, that is wrong. They need to restate it. So restatement of loan for memo. That will be what? 5 million multiplied by what's the rate on 30th April? 2.1 crown. And that will give us how much?
10.5.
10.5. But on the date the loan was given, April 20x4. April 20x4. 5 million multiplied by 2.1. That's 10.5. But at May 20x3, the 5 million would have been translated at the rate on that day. 1st May 20x3, the rate is 2.5. And that would have given us how much?
12.5.
12.5. So that means there is what? That means there is a gain of 2. I mean, because the rate at the beginning, the value at the beginning has dropped. When they want to pay now, they will need 10. They actually borrowed. What they borrowed when they converted it is 12.5 million crowns. But when they are repaying, they only need 10.5 million crowns to repay that amount. So that's an exchange gain to them. And the exchange gain should be debited to where? To the non-current liability, loan from memo. While it will be credited to where? To their SOPL. It's another income for them. Okay? The next thing is, sorry, take this to OCI because you know it's a translation gain, not realized gain. They haven't made the payment. It is at the point where they make the payment, they can now refer to it as a realized gain, that they will now show it in their SOPL. Are we getting it? So that's that about that. The next thing is what? We have this, okay? So we can go ahead to translate. So we have translation of SO, give us SOFP first. Translation of SOFP. We'll have crown in million, the exchange rate, and dollar in million. So for the non-current assets, we have what? PPE 146. And we have already understood that what? Exchange will be done at the closing rate, which is 2.1. Don't forget, these are the same currency, we'll be dividing. Then the next one we have is current assets, 102 at 2.1. Then what? Equity. This will give us a sum of what? 248. For equity and liabilities, we have what? Ordinary share, 32. But this will be translated at what? At the opening rate, which is 2.5. The next is what? Share premium, 20 at 2.5 also. Then retained earnings. For the retained earnings, we will now have what? The retained earnings they reported is 95. But with this corrections we did, we have to adjust these retained earnings to what? We'll adjust the retained earnings to, we are debiting SOPL here, meaning we'll be deducting it with what? 1.2. I mean, and we are crediting OCI here. We should bring that as other reserves. Should bring that as other reserves. Figure
93.8. But sir, please, can you explain this one again?
93.8. Which one should I explain again? The
So you just did
95
now.
minus 1.2.
Yes.
So remember when we did this analysis, we said what? This 1.2 is an exchange loss. And why are we taking it to SOPL? It is a realized exchange loss. They've already lost the money. What do I mean? When they bought the inventory is 12 million crowns to them. At the time they are paying 13.2 million. The excess of 1.2 million is a loss to them. And that loss should have been deducted from their profits for the year, which they did not do. Are you getting it?
Yes.
But so we'll now have what's it called? We'll now have other components of equity, OCE. Other components of equity, exchange difference. How much? 2. But you know this is a gain, so it will be a positive figure. So what do we do? Oh, sorry.
Sir, please, I want to ask a question.
Go on with your question. We are
I
supposed to
thought we
split
used
this,
to.
right?
Okay, yes.
That's why I just said. That's why I'm saying sorry. So I just recalled that we are supposed to split. So we have pre and post. For the pre, on the date of acquisition, they told us that what? Their retained earnings was 80 million crowns. Have we? So we'll bring the 80, we are translating that at 2.5. While for the post should now be what? The 95 minus the 80 minus the 1.2. So that will be based on the what? The balancing figure. That will be based on the balancing figure. OCE, exchange difference, is 2. And this will be translated at what? This will be translated at what's the closing rate? 2.1. Abi? Because that exchange difference was at the end of the year. No, the exchange was, they took the loan from the beginning of the year to the end of the year. So what's the okay? So we move to the next thing. Non-current liability. Non-current liability. What do we have for non-current liability? We have, okay, they did not break it down. They just gave us the full value. Non-current liability is what? 41. 41. And that will be exchanged at what? 2.1. Current liability is what? 60. However, for this current liability too, there will be an adjustment. Remember, this 1.2 was left in payables. And the correction we are doing is to credit payables. So we have to take it out from there. Have we? 1.2. Sorry, we are crediting it to payables, meaning we are adding it. We have 1.2. And this should affect our non-current liability. So this should be 61.2 at 2.1, why this should have been 41 minus 2, and that should be 39. So can you give me figures for all of this? So what's the sum for this? This should also result back to 248, because this one minus a plus a plus a minus a still having a nil effect. You haven't given me this figure. It should be 13.8, Abi.
Yes, 13.8.
Oh yeah, figure for each.
69.52.
40.
48.57.
No, let's just use 1 dp. Don't let us go too far, please.
12
Okay,
point eight.
48.6.
Okay. This
12.8.
12.8.
8.
Uh-huh.
32.
So this one will give us what?
0.95. That should be 1.0.
That's 1.0. 1.0.
18.6.
18.6.
29.1.
29.1.
So what's the summation?
So that is 16.6 for the post acquisition.
16.6 for the post acquisition. Huh?
Yes, sir.
So that will give us what in total? 118.1, Abi.
Yes, 118.1.
Okay. What do we have next? Calculation of, oh no, we still need to translate our SOPL. Need to translate SOPL. Apologies, this OSC should be translated at the average rate for the year. Because you know it transpired between beginning of the year to the end of the year. And if we are to translate profits for the year, we would have used the average rate. Remember that why we are not putting a rate to this post acquisition is because it will be difficult for us to get the whole what's it called? Are you sure this one is 16.6? Hmm? Yes.
Yes, it was 16.6.
Okay, no problem. So translation of SOPL, we have what? Revenue revenue 142, cost of sales 96, gross profit. Gross profit is what? 46.
46.
Then distribution and admin expenses 20. So with that, we have profit from operations to be 26. Then we proceed further to say interest receivable oh, they don't have interest receivable, but they have interest payable. Interest payable. True. Then we will have what? Exchange loss. That exchange loss they did not bring there. 1.2. Then that will now make our profit before tax to be how much? 20. Change because of the 1.2. That should be 22.8.
2.8. Yes.
Income tax expense 9. And with that, our profit for the year will be how much?
13.8.
18.8.
No,
OC
13. 13.
exchange gain exchange gain 2. And that will now make our total comprehensive income to be how much?
15.8.
15.8. And the average exchange rate for the year is what? 2. So that even makes our conversion easier. So with this will be what? 71, right? And this will be what? 48. And with that, our gross profit will be what? 23. Abi?
Yes.
This will be
Yes.
10,
15.
and this will be what? 13. This will be 1. This will be what? 0.6. Abi?
Yes.
So that will give
Yes.
us what? 11 point what? 0.4. Abi? And this will be 4.5 to make this what? 6 points. Is this 6?
Yes.
Is this 6?
6.9.
Yes, 6 point what? 9, Abi?
9. Yes.
And this will be 1, making everything 7.9. Abi? Okay. Having done the translation, we proceed to calculate goodwill. Goodwill. Okay. The goodwill will be purchase consideration. Purchase consideration is how much? They told us they acquired them for how much? For 120 million crowns. And on that day, the exchange rate is what? 2.5. Abi? NCI. I don't know if they told us NCI is measured in any way. Okay, they said it's proportionate share of the fair value of the net asset. So that means NCI will be 25% of what? Of the net assets, which will be all of this. The net assets will be what? 132. No, yeah, 132.
Yes. 132.
So that will give us how much? Less
33.
fair value of net assets. Fair value of net assets is how much? 132. convert that to a 2.5, 2.5. And with this, goodwill at acquisition will be how much? Then we less impairments. We are told that impairment is how much? Impairment is 4.2 million crowns. And we'll have
That the NCI is 33.
huh?
I said the NCI is 33.
NCI is 33. Alhamdulillah, ẹ padà dé láti jẹjọ. Exchange difference. Kí ló tó ń wò mí bí obìnrin?
Goodwill acquisition is 153.
153 ní goodwill kẹ̀. Onígbó
21.
Yeah, sorry, yo.
21. 21, 21 minus 4.2 will give us what? 16.8. Okay, so give me the translated value, please.
48.
48.
13.2. 52.8.
So what will be the goodwill? 8.4. Okay, so impairment. At what rate do we translate impairment? At what rate? So we have the closing rate to be what? 2.1, Abby. So that will give us how much? So what do we have?
6.4.
We cannot get it to be 6.4. We'll translate the consolidated goodwill at the closing rate. 16.8 times 2.1 divided by 2.1 will give us what? We'll translate this at 2.1 to get the exchange difference. 8. So if it is 8 and you calculated this to be 6.4, what will be the what was it called? What will be the exchange?
1.6.
1.6, positive or negative?
Positive.
Positive. That means it's an exchange gain. Are we getting it?
Yes, sir.
Okay. The next thing is to calculate the NCI. That should be note 7. NCI. NCI will be what? Value at acquisition, which is 33. 2.5. We don't really need to do this. Let's just use the dollar directly. Value at acquisition in dollar is 13.2. Share of post acquisition. What will they share? They will share post acquisition earnings is because we have OCI, we split the post acquisition earnings into 2. Share of post acquisition retained earnings will be what? 25% of 6.9. You know, I'm using the 6.9 directly because it is what is it called? Yeah. Something is wrong here. Something is wrong. Wait. 10.6. The translation difference. Let's see. Translation difference. That was costing 16.6. Okay, no problem. Let's move. So I'm using 6 point. Sorry, I'll use what we have here. Let me see if I'll be able to bring home my points. So we'll be using what the 16.6 we have in the statement of financial position. I will try to drive home a point. Let me. So 16.6, 25% of it, another component of equity, 25% of what? Of one. That will give us what, please?
3.32, the first one. And 0.25.
I'm coming. 20.
I said 3.32 for the first
For the
one.
first
Then
one,
0. Yes.
3.3. Then the second one, 0. What? 0.25, Abby.
Yes.
So let's say that will also be 0.3. But let's be careful because we've rounded up here. We have to round off in the second one when we are splitting it so that we will not overstate the figure. Aside this, there is impairment. This thing, the NCI is measured as proportionate share, so they cannot share impairment. So what will be the summation for this?
16.8.
16.8. Okay. 16.8. After NCI, we calculate what? Group retained earnings. Abi? So
Yes.
for the group retained earnings, we have what? Memo retained earnings. Memo retained earnings is how much? Memo retained earnings is 360. Then share of post-acquisition earnings. They will share 75% of 16.6. And that will give us how much? That will give us how much? Aside that, what else do we have? Ooh.
0.45.
Ladies and gentlemen, I'm glad to inform you. 9.4, Abby. 9 point what? Should be 9.3. Should be 9 point. Abby. It cannot even be 9. Please, we calculate because if this one is 3.3, this one cannot be 9.3. But
I said 12.45.
Emma so okay now. So that will be 12.45. I don't seem to understand.
Sir, please, where do we get that 16.6?
Here now, Mama. This one here, the post-acquisition earnings. Or is that not what you translated for us?
Okay, sir.
And then, what do we have? Please, 12.45. This will be 15. I'm not sure this thing is correct. So confirm this for me, please. This 25% of 16.6.
4.15.
So that should be 4.2, Abby. Because I know the summation of both should give me back the 16.6. So if that is 12.4, Ladies and gentlemen, I'm glad to inform you that there's something this will be incorrect too. What should it be? That should be 17 point what? 0.7. You actually jinxed this question. Because the first time we solved it, that was how you were giving us one thing that we completed. So we have what? Share of post-acquisition earnings, this. Now, if you look at this place where they said they bought raw material, they told us half of the raw material were still in inventory of random. And if half of the raw material was still in the inventory of random, that means the unrealized profits, we need to take care of it, right? We need to take care of the unrealized profits. So let me just calculate here, note 9, unrealized profit on inventory. And that will be what? That will be, they told us profit percentage is 20% on selling price. And you'll agree with me that the selling price is the 6 million, right? So 20% of 6 million divided by 2, because only half is remaining in their inventory. They sold that. So that will give us how much?
0.6.
0.6. So we have to bring the unrealized profit here. Unrealized profit on inventory. Unrealized profit on inventory. 0.6. Then what's it called next? Impairment of goodwill. How much? Impairment of goodwill is 2. Then what else do we have? Impairment of goodwill is 2. Then what else do we have? We have exchange difference on goodwill. How much?
1.6.
1.6 gain. That will be added. Abi? What else do we have? Any other adjustment that should affect? These two have already affected the subsidiary. We don't need them here again. Don't need them here again.
Question. I want to ask a question.
Ask your question. It's loving go. It's loving so.
The unrealized profit.
Yes, ma'am.
It's not affecting. It's only affecting our
It will affect consolidated inventory. Consolidated inventory. So when we get to inventory consolidation, we'll take care of it there. But if you are hungry, we can leave other things and go do it now.
That will not affect SOPL also?
No. Will it not affect SOPL, the unrealized profit? And when we get to SOPL now.
Okay.
Okay. We have exchange difference. Aside that, I don't think we have any other thing. Ladies and gentlemen, give me the total value. Let me run away from this place. Note 9, OCE. Group OCE, since the parent does not have other components of equity, we'll just bring their share of the other components of equity, share of PAE. That will be 75% of 1, and that will give us what? 0.7. It should be 0.75, but because we've rounded up there, we have to round off here. So that's that. What else do we have? We calculate the total exchange difference. Abi? So if the total figure we are sharing is 1, we've taken 0.3 to be for this one. We cannot take this one to be 0.8 again to become 1.1 to become an issue. So what do we have next? Note 10. We are done with the adjustment of SOFP. The only thing we have left is adjustment of SOPL. And the adjustment of SOPL is what? Total exchange difference for the year. Total exchange difference for the year. So what will be the total exchange difference for the year? Closing net assets. Closing net assets at the exchange at the closing rates. That will give us what? So all of this, summation of all of this will be what? Figure. This is 20. Let me show you by. Yeah, what I'm going to do the
69.4.
No. It's stopping here.
Are we adding the
69.4. No, don't add the 1.0. 69.4. Then let's opening net assets. How much is the opening net assets? We'll add only up to these points. You know, the 16.6 is closing net is post acquisition. So the pre-acquisition is up to this 32. What do we have?
$52.8.
52.8. Then we'll have what? 16.6. Then we'll less profit for the year. The less profit for the year. What's our profit for the year? Profit for the year, translated profit for the year is 6.9. 6.9. And there was no dividend. And even there was dividend, we'll deduct the dividend from this profit for the year before getting the total this thing. And that will give us what?
9.7.
9.7. That's our exchange difference. And this exchange difference is the gain. The gain. Why what? But pardon me, I just want to test something. The total of this, the total closing net assets based on the foreign currency is 147, Abi. So do 147 divided by what's the closing rate? The closing rate is 2.1. And do 132, which is the opening net assets, divided by opening rate, which is 2.5. That will give us what?
First one, 70.
70. Second one, 70. No point. Something.
Yeah, just 70.
Second one,
52.8.
52.8. So that will give us what?
17.2.
17.2. Okay. So if we have this exchange difference, so then we bring the exchange, this exchange difference is a gain. Exchange gain on goodwill is how much? I think it was 1.6, Abi. 1.6. So if we add the 1.6 here, what do we have in total?
11.3.
11.3. Okay. 6.9. Don't mind me. Then do 13.8, which is the translated profit. Hey. Okay. 13.8 divided by 2.1, which is the closing rate. That will give us what?
6.57. So what are we trying to do?
6.6. You shall the one go ma wo mi o ma wo mi. 6.9 minus 6.6 will give us what? 0.3, Abby. 0.3. So this will give us what? 17.5. Okay, don't worry.
Sir, please, I want to ask a question.
Go on with your question.
That opening net asset,
Yes.
the 52.8.
Yes. What happened to it?
How did we get that 52.8?
So you know the opening net asset here is what? 12.8, 8, and 32. Abby?
Okay.
Yeah. It's the summation that gave us the 52.8.
Okay. But there's something that you did in last class. You did date of the opening net asset as
So
date of consolidation
I used
minus.
yeah. So what I did here was because you know the date of acquisition is still the same thing as the opening is still the same thing as the opening date for this year.
Yes, sir.
That's why I did it that way here.
Okay.
Okay, so having done this, that's the total exchange difference for the year. We have what? We have 11, note 11, adjustments of do we still need to adjust the subsidiaries profit? I don't think so. We've already taken care of what we need to adjust. So let's consolidate the issue. Consolidated statement of profit or loss for the year ended what am I doing? I'm consolidating SOFP first. Because they gave me SOFP first. Statement of financial position as at 30th April 20x4. This thing ó ti tóbi jù mo kàn waste the space lélẹ́yìí o. So we have what? PPE. Our PPE will be what? The parent 297 plus the subsidiary 69.5. And that will give us how much?
366.5.
3
366.5.
366.5. 366.5. After PPE, investment in random cannot come. Loan to random. Loan to random. We need to write that one off, Abi. 5 minus 5. That will be need. Then current assets. Current assets will be what? Yeah. 355 plus what's the translated inventory? Translated current assets, 48.6. 48.6. Then we take out the unrealized profit, 0.6. I think that's the only adjustment we have here. Figure. Ooh, goodwill. Goodwill. Current assets. I want to rub off the goodwill. I want to rub off the first one to write goodwill. So goodwill is how much? We calculated it to be 8, right? 8. Figure for the current asset?
403.
403, 453. Which one is right?
403.
Okay. Summation of everything. We have what?
777.5.
777.5. 777 is the number. Let's see. Ordinary share. 60. Share premium. 50. Group retained earnings. We have that to be how much? You guys did not give me group retained earnings.
371.4.
371.4. You called it. Ẹ má bínú, etí tí mò ń náwó sí ni mo mú wá kíláàsì lẹ́nu. Group OC 7.7. So shareholders fund will be how much? NCI 17.7. Me go.
482.1.
Okay. Then non-current liability will have what? 30 plus what's the translated value? 18.6 minus what? Minus 5. Because that loan we take out here is intra-group loan. That will give us how much? Current liability. Current liability, what do we have? 205 plus what? 29.1. 205 plus 29.1. Any other adjustment? Figure
Current liability
is what?
So what of the loss on exchange?
Loss on exchange. Èmi ò ní loss kankan o. We've already adjusted it. Wait. You know we've adjusted it here before translating.
Okay.
We need the part. That's why we adjusted the distance. So we will not need to do that. What we'll be adjusting for in consolidated accounts are only group adjustments. That's why we will not do group adjustments in the translation of their whole separate financial statements. Do you understand?
Yes, sir.
Figure.
43.6. Non-current liability.
43.6.
Then 234.1.
234.1. 777.5.
Yes, 777.5 balance.
So let's consolidate the SOP here. Consolidated statement of profit or loss. Questions, any issue? Is it that the figure is not correct?
No, I'm talking to Fortune. She's sending
What's
too
my
much.
you guys are in the same place? What's the meaning of that? Consolidated statement of profit or loss for the year ended 30 April 20x4. What do we have? The 13th of November. Which one do? So, right. Okay. Oh yeah, let's quickly do this. I need to go. My prayer time has passed and I also have other things to do. My wife and kids are waiting. Revenue. How much? We have 200, Abby, plus what? What's the translated revenue? 71. 71 minus intra-group sales of 6 million, and that will give us what? Cost of sales.
265.
265. Precious 2025. Cost of sales is 120 plus what? 48. 48 minus 6 plus 0.6 unrealized profit. That will give us how much? That's why we need to do.
162.6.
162.6. So what's our gross profit?
102.4.
102.4. So the next thing is what? Distribution and administrative expenses. We have what? 30 plus what? 30 plus 10.
40.
40. No adjustment. Then what? Wait, there was impairment during the year now. Impairment of how much? Impairment was 4.2 during the year. They did not tell us where we should take impairment to, right? But average rate is 2. So 4.2 divided by 2 is what? We can take impairment to admin expenses. Huh? 42.1.
No, I mean, no. That's just for payment.
Big boy. Hello?
Yes, 42.1, yes.
Ta ló wá ń bá mi jà tẹ́lẹ̀? What do we have? Profit from operations. 60.3. Then interest receivable. So because they told us that the loan they gave Random is interest free, we already know the interest receivable here cannot be inclusive of the interest on the loan they gave to Random. So we'll just take the interest receivable like that. But if that loan it has interest element in it, we have to take out the interest receivable and payable between both parties. So, but since there is no intra-group interest, we can go ahead. So, having done this, the exchange loss are supposed to have adjusted for it here. Please, let's adjust for the exchange loss also. What's the exchange loss? 1.2, Abby. Please help me adjust for it here. That should be 43.3, Abby. Please give me this. Figure. Huh? 59.1. So what's the profit before tax?
1.1.
61.1. Income tax expense will be what? 20 plus 4.5. Didn't I convert it? Hey, thank you. Interest, we are supposed to use converted value, which is how much? Should be 1. No, this one should be I'm very, very sorry. I think it's because my wives and kids are already giving me signal that what I did is enough. The exchange loss converted is 0.6. The interest payable is 1. I mean converted figure. Translated figure. We cannot use the full value here. This is 4.5. Figure. Yeah. Oh yeah. Oh.
42.7.
42.7. And what will be the profit from operations?
59.7.
59.7. And what will be the profit before tax? 52.7.
62, not
62.
62.7. So profit after tax will be what? Then OCI, we will have exchange gain. Oh yeah. Oh. So total exchange difference, we calculated that to be what? 11.3. So So with this, total comprehensive income will be how much? $50.5. Profit for the year attributable to owners of memo NCI. What will be the NCI portion? NCI will take NCI profit is 6.9. 6.9 minus the unrealized. No, the unrealized profit is not affecting them. They are not the ones selling. So if the unrealized profit is not affecting them, impairment is also not affecting them. Nothing is affecting them because they are not they did not share out of it. So that would just be what? 25% of 6.9. And that will give us how much? Why these people will take 38.2 minus what? Figure. 1 point. That will be 1.8, Abby.
No, it was 1.75.
Okay, that will be 1.7. So what do we have? That should be 36.5, Abby. So total comprehensive income attributable to owners of memo NCI. This will be 25% of what? Owners of memo will share what? They will share from the 6.9 profits. They will share from the exchange gain on loan, 1, and they will also share from the exchange difference on the activity, not from the exchange difference on goodwill, because they did not share. The goodwill NCI was measured as proportionate share. So what's the exchange difference in the activity itself? 9.7. 9.7. So if you add up all of this, multiplied by 25%, that will give us what?
$4.4.
So this one will be 50.5 minus 4.4. And that will give us how much? 46.1. Ladies and gentlemen, thank you very much for your time. Yorùbá wa ní òun ní ká jẹun pẹ́ lẹ́nu.
One more question.
What is your question?
No, I mean we should solve one more question.
Thank you, sir. Appreciate it, sir.
Don't worry, I'll solve more questions, but not tonight. Maybe I will reschedule one more class, but it definitely cannot be tonight again. I have another engagement now that I need to get ready for. I'm
Okay,
even late as we speak. Yeah. Thank you very much for your time. I will share the